cryptocurrencies are rising, and many investors hope to profit from their quick climb despite their well-known volatility. This is also true of many other popular digital currencies, such as Bitcoin and Ethereum, which first ebbed before surging higher. Veteran traders have been making predictions about cryptocurrencies for years, but what if you're new to the market and want to get involved? Here are some tips on how to get started investing in cryptocurrencies and things to look out for. But before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. If you wish to invest in cryptocurrencies, your financial situation must be in order first and foremost. This requires setting up an emergency fund, taking on debt that is manageable, and ideally having a broad investment portfolio. Investing in cryptocurrencies might result in expanding your portfolio and, preferably, improving your overall performance. As you begin to invest in cryptocurrencies, pay attention to these 5 additional factors. Number 1. Understand what you're investing in. Just as with any other investment, be certain of what you are investing in. It's essential to thoroughly investigate the company and read the prospectus before buying stocks. Since there are literally hundreds of cryptocurrencies, each of which runs differently, and more are being created every day, plan to follow the same approach for all of them. You need to understand the investment rationale for each deal. Many cryptocurrencies have absolutely no basis in terms of either tangible assets or money flow. Investors in Bitcoin, for instance, entirely depend on someone else paying more than they paid for the goods. In contrast to equities, where a company may boost its earnings and generate returns for you that way, many crypto assets rely on the market becoming more optimistic and bullish for you to earn. The 4 most well-known digital currencies are Cardano, XRP, Dogecoin, and Ethereum. Solana is another coin that has had great success. Therefore, before making an investment, be aware of the possible gain and downside. If your financial investment is not backed by an asset or cash flow, it risks losing all of its value. Number 2. Remember, the past is past. Many inexperienced investors make the mistake of extrapolating past performance into the future. Yes, Bitcoin was previously just worth cents, but now its value is much more. The important question is whether that growth will continue, even if it does not proceed quite as swiftly. Investors put more emphasis on the future than the previous performance of an asset. What will drive future returns? Investors in cryptocurrencies now need returns from the future, not gains from the past. Number 3. Watch that volatility. The values of cryptocurrencies are the most erratic assets. Depending just on a rumor, they may vanish in a matter of seconds. For seasoned investors who can swiftly execute trades or who have a solid grasp of the market's fundamentals, present trend, and possible future directions, it may be fantastic. For inexperienced investors without these skills or the complex algorithms that direct these trades, it is a minefield. In the volatility market, powerful Wall Street traders compete to outgun other rich investors. A new investor could get quickly overwhelmed by the volatility. This is due to the fact that volatility rattles and frightens traders, particularly newbies. Another trader might come in at a bargain. In other words, professional traders may buy cheap and sell high, as opposed to beginner investors who buy high and sell low. Number 4. Manage your risk. Risk management is crucial when dealing with volatile assets like cryptocurrencies, but it may also be crucial when trading any asset on a short-term basis. Because of this, as a less experienced trader, you'll need to understand how to manage risk and develop a process that helps with loss reduction. The approach may also vary from person to person. To never sell, regardless of price, may be the most straightforward method of risk management for a long-term investor. Because they have a long-term perspective, the investor can keep the position. But a short-term trader may manage risk by creating strict rules for when to sell, as after a 10% loss on an investment. The trader then scrupulously follows the instruction to avoid a little decline later becoming a catastrophic loss. Beginner traders may first consider setting aside a certain sum of trading funds and spending just a portion of them. If a position changes in the other direction, they will still have money in reserve to trade with. The simple line is that you cannot trade if you do not have any money. You can guarantee that you'll always have a trading account by keeping a cash reserve. Although risk management is important, it will cost you emotionally. Although giving up a lost position hurts, doing so may save more serious losses from occurring. Number 5. Don't invest more than you can afford to lose. Finally, it's important to avoid using funds you need to invest in risky assets. If you can't afford to lose it all, you shouldn't invest in risky assets like cryptocurrencies or other market-based assets like stocks or exchange-traded funds, or ETFs. Money that you will need over the next several years, whether it be for a housing down payment or another major purchase, should be kept in secure accounts so that it is there when you do. Paying off debt is also your best option if you want a return that is 100% assured. You will undoubtedly earn or save money, regardless of the interest rate on the loan. There is no room for loss. Consider the security of any exchange or broker you utilize, last but not least. Even while the assets are technically yours, someone must still keep them safe, and that security must be strict. If they don't think their cryptocurrency is safely guarded, some traders choose to invest in a crypto wallet to keep their coins offline, making them unavailable to hackers or others. How much money do I need to start investing in cryptocurrency? In theory, purchasing cryptocurrency only has a little financial impact. For instance, most Bitcoin exchanges demand a minimum trading amount of $5 or $10. Other cryptocurrency trading platforms may have a much lower minimum requirement. But it's important to be aware that if you just trade little amounts of Bitcoin, certain trading platforms impose outrageous fees. It's critical to choose a broker or exchange that lowers your costs. Many brokers who advertise themselves as free, in fact add commissions, also known as spread markups, to the price you pay for your Bitcoin. How can I invest in Bitcoin? You may invest in Bitcoin in a variety of methods and with a variety of companies, such as conventional brokers and cryptocurrency exchanges. Exchanges provide the widest selection of cryptocurrencies and typically have the most competitive pricing. There are literally hundreds of additional participants, but Coinbase, Kraken, and Binance are some of the leading ones. Many conventional brokers allow you to trade Bitcoin in addition to stocks and other financial products, but many only provide a limited selection of other cryptocurrencies. One of the top rivals in this market is Interactive Brokers, along with TradeStation and Tastyworks. That's it for today's video. If you would like more videos like this, then let me know in the comment section below. If you enjoyed this video and need to hear from me again, make certain to hit that subscribe button before you go. Thanks for watching.